that entire market segment collapsed. Credit default swaps as attached to RMBS, which is residential mortgage-backed securities, that entire process fell apart, right? Because what happened was when the house prices, because the mortgage-backed securities are premised, their value is premised on the value of the house, right?
Correct,
the minute there was a house price collapse, those pieces of paper
don't become valuable anymore.
They became worthless, and there was nobody to guarantee, because the margin calls against AIG led to it being bailed out by the Federal, by the Treasury. The U.S. Treasury had to step in, and they literally had to pay off everybody without a haircut. Everybody who was using AIG to guarantee their balance sheet to the bank. So this was actually one of the mega things that detonated the great financial crisis. The other thing was that these the assets that were generated, all these mortgage-backed securities that were used, generated by the banks, right? This is, I'll give you a parallel of something that happened just last week. So the bank's assets that it generates, the loans that it gives out, those pieces of paper, now it's more securitized or whatever, were then used to generate liquidity in the repo market, right? They used their own assets to then underpin as collateral borrowing that they were going to do in the interbank market, in what they call repo. And then that also fell apart, because what happened was they were using these pieces of paper that were backed by house prices to borrow money short term in the short-term money markets from other financial institutions to what? To fund their long-term liabilities, long-term loans on the mortgage market. So that is how, institutions like Northern Rock fell apart, because, the minute you use a piece of paper to borrow money, if that collateral then loses value, which it did when the house prices fell, nobody was prepared to lend on it. And then again, the Federal Reserve unprecedentedly had to buy all these toxic mortgage-backed securities, because it had to become what Willem Bouter calls the market maker of last resort. There was nobody prepared to hold that. And these were called the asset-backed commercial paper conduits, which are over 300 billion large. So that also fell apart. So everything associated with the leveraging up, so to 65 times leverage is, as I told you, banks were made into hedge funds. But they didn't become that way of their own
65
bat.
times is just a crazy amount.
Crazy amount. I mean, and was there enough reserves or enough liquidity or anything like that? No, none of that was regulated. They were just told. So these are all errors of such proportions, of very poor design of regulation. It's called perverse incentives, and then of course what we call fallacy of composition. What is true for one bank is not true for the whole system. We've developed what are called agent-based models, which said that the first thing any regulator needs to do is to make sure, take their regulation and have everybody follow the letter of the law. Means to say, have them, everybody, if you give incentives of this ilk, say you can reduce capital from 8% to 1.6%, who wouldn't jump at that, right? Yeah. But what is true for one bank is not true for the system as a whole, because if everybody did that, whoever has to guarantee all that risk, all the credit risk that they would be generating with 65 times leverage, wouldn't have the liquid assets. They ran out of money. AIG, when the margin calls came against them as their credit default swaps started to detonate, as the underlying bonds, which is the residential mortgage-backed securities, lost value, they were getting margin calls thick and fast, and they didn't have any reserves put aside to meet that.
Which is obviously just the risk of being so highly leveraged, right? Just in the first place.
Yeah, it was important. There was nobody who would have that sort of liquidity. No. So why did, so what I'm saying is, this is now called systemic risk. We should have joined up thinking. We should have digital mapping of financial systems.